Ladies and gentlemen, welcome to your favorite podcast. This is Real Estate Investor MBA.com. We created Real Estate Investor MBA to leverage the knowledge of giants through synthesizing and providing much needed information to all investors, from the veteran investor to the new and aspiring investor. At Real Estate Investor MBA, we plan to cover pertinent information head-on with our expert guests who we will interview on what they are doing and preparing for in the days and years ahead. We aim to create MBA quality curriculum topics and themes from the information garnered among our interviewed guests in order to bring world-class value to our fellow community of listeners. We truly believe that rising water raises all ships, and by sharing this leveraged knowledge, we can create a stronger online community, which translates to stronger local, regional, and national communities. Your hosts are Jeremy Moyer, who is a veteran real estate investor and author of a new book called Are You Playing the Real Estate Game Blind? As well as Tejas Gosai, the owner of eXp Realty, the Tejas Gosai team, and also co-manager in a newly formed Regulation D private equity fund called the Lehigh Valley Private Equity Fund. Now let's get to the show. Ladies and gentlemen, welcome to your favorite real estate podcast. This is Real Estate Investor MBA. My co-host, Jeremy Moyer, is the man in charge, helps us get our amazing guests. And we'd like to start off with a big thank you. We have had a tremendous amount of support. A lot of fun to do this, right, Jeremy?
Absolutely, yeah.
And a lot of the folks that we have on really take the kind of initiative to share some serious details about their life and how they stay motivated, things like that. The real estate world is endlessly difficult. No matter what, it's not easy. There's never a day that's like, all right, I got this deal. Everything worked out the right way. There's a lot of navigation. So we're happy to share that. We're all over the internet, Spotify. Actually, Jeremy, where are we?
We're on iTunes, Spotify, Stitcher, TuneIn, Google Podcast. We're in a lot of different places.
Yeah, and we owe you guys for that. So real quick, before our guest, I'm just going to share a couple pieces of information. The Lehigh Valley, this is our market Jeremy and I have been in, and it's performing really, really well. We just had one of the biggest acquisitions take place. Rockefeller Group sells Lehigh Valley Warehouse for $201 million. We are one of the fastest growing industrial and warehouse markets in the Northeast. And so this is just a testament as to what's happening here. We see a big change in real estate, a lot of owners that have been in the market for years and years, and a lot of new people coming in. So it's great to see this. Also, Lehigh Valley economy highlighted by CNN, Wall Street Journal stories. So this just took place recently, and it was just a highlight of how much the Lehigh Valley economic growth has been covered. And Amazon has a 1 million square foot warehouse. There's actually a few Amazon warehouses out here. And then Nike just moved in with a 1 million square foot warehouse. So this is just some of the asset classes that we're looking at, but multifamily has been bananas. And that's where Jeremy and I focus a good bit of time in. So Jeremy, anything on that? It's been interesting.
Absolutely. No, there's a positive trend, that's for sure. So we're really excited. Yep.
It's a lot of fun. But thanks for letting me share that. Jeremy, let's get to our guest.
Sure. So for the show today, we have Jerry Kranzel with us. So Jerry joined CBRE in 2012 as a senior vice president with CBRE Capital Markets in Philadelphia, and is also a senior member of the CBRE's Institutional Properties Group. Jerry has consistently been a top producer over his 20 plus years of experience in investment sales, specializing in the sale of suburban and CBD office. His clients have included REITs, institutional and private equity owners, and corporate sellers. Prior to joining CBRE, Jerry held senior positions in investment sales with Jones Lang LaSalle and Cushman and Wakefield. And just to name a few of the clients he represented, they include AIG, Bank of America, Children's Hospital of Philadelphia, DuPont, Invesco, JP Morgan, Northwestern Mutual, and Vanguard. So Jerry, that's a pretty impressive resume. Thank you so much for joining us this morning.
Thanks so much for having me on, guys. Pleasure to be here. I want to say I think it's 20 plus now. I probably need to update the number of pluses on the 20 years of experience.
Nice.
That's great. Can you give a little bit more about your background before we jump into some specific questions?
Sure. So I've been involved in the sale of investment properties for over 25 years. That's always what I've done. I've sold every property type over my career. So industrial, office, retail, and multifamily. For the last 9 years, I've been at CBRE, and I've been on the senior investment sales team in the institutional group selling office buildings. And that runs the gamut. It's Center City Philadelphia, and other market high rises. It's suburban office product, multi-story, single story. And we've increasingly done a lot of single tenant transactions over the last 5 years. There's been a tremendous market for that. And we also get involved, and the demand in these areas has really increased over the last several years in the sale of medical office buildings and also lab buildings. So it's exciting. It's fun. I love going to work every day. We've all been working virtually for, at least a portion of the time. I am sitting in my office in Center City in 2 Liberty Place right now, but it's a great business to be in. Thanks for having me, guys. Tremendous.
Absolutely. So I kind of want to get right into it. So like at a high level, we're hearing a news different days, different weeks, about high dense cities, and how they've taken hit, during COVID. What are you specifically seeing on the ground within the suburban central business districts within Philadelphia, and how it's, surviving COVID and kind of adapting to it?
So I think you're seeing across the country, and it's not just in Philadelphia, you're seeing big employers being very reticent and very thoughtful about how they're bringing their workforces back into the office. And in some cases, they're going to continue to have people work from home, and that may not be full-time working from home. I mean, what CBRE is projecting across the country is once we get back into the new normal, whatever that looks like, that there'll be an increase in flex work. So, and this is increasing trends that had already been in place. This isn't something brand new. Our office environment, both in our main suburban office in Radnor, Pennsylvania, and in Center City, Philadelphia, is completely hoteling. In other words, no one, including the guy who runs our market, has his own office. You go in, you work in a workstation, or you can reserve an office for a day. But it allows you to work from multiple offices. It allows you to work from home. But clearly, over the last 15 months, everyone has figured out how to work from home, right? And I'm dying to be back in the office because the collaboration with my colleagues is a super important part of what I do. But by the same token, everyone is now set up. And so if something comes up and you need to work from home, it's not an issue for the majority of people, not for everyone. But, and for some people, in cases where your children still are going to school virtually, and maybe you have younger children, it's actually a problem being in the office, and you need to work virtually. So we're still seeing a very low level of true occupancy in office product, both in the suburbs and in Center City, Philadelphia, and this is true certainly in the Lehigh Valley too. I'm on the 30th floor of the building that we occupy, and today was the second day that someone else was actually in the elevator. And that's actually a tremendous problem when it comes to office. And you talked about another problem. So we'll just start specific to downtowns, high-rise office buildings. I mean, the Valley, Allentown would have, a lot of product like this. Allentown, I don't think, has so much of an issue with employees arriving in public transportation, but in Philadelphia, 65% of the employees arrive on public transportation. So even with people coming back to work, feeling more secure, with increased levels of vaccinations, there are lots of people who are still not comfortable getting on public transportation and being, on a train or a bus that's full of people. And that's a problem for CBDs right now, at least until people get more comfortable with that kind of, interaction and that kind of proximity to other people. And for office buildings specifically, if you're in a high-rise office building, I mean, if you guys have been in buildings with elevators, there's probably signs about how many people can be on an elevator at one time. There may be markings in the elevator where they want people to stand, and that's going to be an issue. And I think CBRE's position, certainly Jerry Kranzel's position, is that over time, that will, again, it'll be normal, or it'll be a new normal. People will just become more comfortable with that as people feel safe physically, as everyone who wants to be vaccinated gets vaccinated. But right now, sitting here in May 21, it's still an issue. And so what that's doing is, there are certainly buildings and there are certainly submarkets where more people are in the office, but across kind of the broad spectrum, we're really only seeing maybe 10 to 15% of actual people in the seats in center cities, with high-rise office product. And in the suburbs, it's probably more like 25 or 30%. But then you'll go into an office you'll go into an office park, or you'll drive up to an office building that is fully occupied in terms of being leased, and there's 3 cars in the parking lot, right? I'm sure everyone who's in the business has had that experience.
I'll jump in. I got to share something. I used to work at the Pennsylvania Real Estate Investment Trust.
Sure.
So I was in the Bellevue building when Governor Rendell was like renting from below. But I agree. Office culture, sad. That was our jam. We were way more productive, and it's tough. But you have a lot of clients that you've worked with for years now that have gone into this space, maybe because of you or with you. Now they're suffering. How are you? How do you deal with that? How do you deal with the phone calls?
So most of them are not suffering yet, right? Because occupancy, in the first couple months of the pandemic, if we go back to last March and April, people were really concerned, are people going to pay their rent? And I remember talking to clients across the country, not necessarily even specific to their Philadelphia holdings, and it's this group stopped paying us, that group stopped paying us. Well, that kind of went away. Everyone kind of figured out, and a lot of this, some of it was because of government action. So they put money in people's pockets so they could continue to occupy space and pay their workforce. But basically, we haven't seen, a string of bankruptcies across the country. We haven't seen a dramatic increase in default rates. What it's really done is it's decreased liquidity, especially in the office space. Now, that's not true across the real estate spectrum. I mean, and you just talked about a large industrial transaction in the Lehigh Valley. I mean, the liquidity in the industrial sector is crazy right now, because you're seeing, all kinds of changes in the way that goods are being shipped, and you're seeing, million square foot buildings popping up, everywhere where you can build them, and there's seemingly a limitless demand by capital to buy in that market sector, and that's driven down cap rates and has driven up transaction volume, right?
Sure.
In the office market, it's introduced another piece of uncertainty, because no one knows. We're not at the other side of COVID yet. Nobody knows how much sublease space is going to be in the market, what corporate occupancy is going to look like long run. I mean, is it going to be the normal? Is it going to be the new normal? I mean, we're projecting that's really actually going to be a very small drop in demand. And then the reality is in office space, where you're seeing many tenants signing leases for 10 years or more, the ability to shed space other than through sublease is very limited. So it takes time for occupancy to change. And then I think we're also, our CBRE's chief economist is projecting, and I think everyone is projecting, that as we continue to come out of this and people go back to work, that there's going to be a tremendous growth in employment. And that may just drive enough additional bodies in the seats, as they say, to fill any sublease space. It may increase corporate demand for space. So it's just uncertainty. So my clients who have been hurting, they're really not hurting so much because they're making basically the same amount of money that they're making. But if they would like to transact, if they have a building that's very well leased and they really would like to monetize that, and obviously interest rates are basically at a historic low and they'd like to take advantage of that, it's harder to do that because of the uncertainty in the office space. But you're not really seeing, it's not like the global financial crisis. You're not seeing a tremendous amount of asset level stress in the market right now.
Thanks for that.
So on the capital markets side, do you see a lot of clients, you don't have to name names, but are you seeing clients bullish on the situation at hand? Like they see this as an opportunity to gain market share, gain square footage space within the downtown districts or even the suburban districts, prime real estate. Do you see any trends specifically? What does that look like?
Well, again, the trend, unfortunately, is a lack of activity because, yes, there are we're getting calls every day from buyers who are saying, we're still out there. We still want to buy office, bring us opportunities. But they're excited about the opportunities because they perceive that there's dislocation in the market and they want to take advantage of that. And sellers, current owners are saying, well, I have basically the same income stream that I had a little over a year ago. Interest rates are 100 basis points lower. If anything, my building should be worth more. So you're kind of not seeing the two lines on the graph cross. You're not seeing transactions because you've got sellers who don't really want to capitulate to the market and a buyer who's looking for a premium for buying in a situation where there's more uncertainty. And there certainly is more uncertainty. I mean, no one can deny that. Now, where we're still, as I think I said in kind of the preface, where we're still seeing tremendous demand is if you can take that uncertainty off the table. So where we have office buildings that are leased for more than 10 years, especially more than 12 years, there are deals as long as 20 years. We're seeing tremendous demand. And a lot of that demand, interestingly, is from offshore capital. So a lot of it is from the Middle East. It's from Asia. We're seeing a lot of Korean investors. Now, these are for bigger transactions. For example, we sold GlaxoSmithKline's co-US headquarters, which is located in the Naval Yard in Philadelphia, for over $130 million to a Korean investor a couple of years ago. We've seen a lot of foreign investment in our CBD. CBD is downtown. It's typically for transactions of more than $20 million. But for bigger transactions, you are seeing very, very deep demand by the market. And that's basically because it's like buying a bond, except you're buying a hard asset, right? You're buying a piece of real estate. You can lock in an extremely attractive piece of debt. You can sometimes get interest only on that debt for as long as 10 years. So people are able to get a defined return for a long period of time in a world where there are not a lot of investment opportunities that really throw off a lot of cash flow.
He's chasing that yield, that arbitrage, right? Yeah.
Yep. Exactly.
Okay. So Jerry, if I'm trying to think of a question of how to translate this to our, the information you're sharing to our listeners. So if we have,
not all of your listeners have like $100 million plus office buildings.
No, they do. All of them.
Not a ton. Yeah. I think a lot of our listeners are very used to looking at the data analytics, maybe translating to self-storage or multifamily. What are some data analytics that you guys look at on a monthly basis that you can share with the listeners that are important to the office space?
Well, the thing with office is it doesn't move around as much as multifamily is. It's just not, again, multifamily or hospitality, for example. Hospitality changes, your rent roll changes every day. Multifamily it changes every month. But I think the biggest metric right now that people would want to look at is sublease space, because that is something that can change on a dime. It doesn't matter if a big corporation has 10 years of term left. If they put 100,000 square feet of sublease space out, that's available immediately. So that's something to track. I don't have the most recent numbers, but I will tell you that we were on a leasing call in our office, and again, we cover the Valley, we cover the western suburbs out to Harrisburg, to Wilmington, Delaware, to Central Jersey, and there was one leasing team. This is not for all of CBRE. This is not for, this is not even for an entire office. There was just one team where they had clients that had given them 350,000 square feet to sublease. And that's not one client. That was across multiple transactions. Now they're getting activity with that, but the first thing that we'll have to, once we start to get into recovery, the first thing that we'll have to work through is through some of that sublease space. Typically, in a market like this, you do see a flight to quality. So if you see sublease space in some of the best buildings, that might be the first space to go. But then, kind of counter to that, Class A product with bigger employers has been much more affected across the board than Class B space, and it's affected in different ways, right? I mean, you're seeing the sole proprietor, the accountant, who's just said, who's got, had maybe 3,000 or 4,000 square feet, who said, I'm just going to work from home. Nobody's coming into the office. All my people are working from home. But you need a lot of those to aggregate up to equal the impact of 100,000 square feet of sublease space being put onto the market. So sublease space is a really great variable to track. We do track it, and then when it gets absorbed in two different ways. And one is, obviously, there are third-party lease transactions where people come in and lease space and take that sublease space off the market. But what we've also seen coming out of, and I've been through a number of these business cycles, what we've seen is that companies will just reabsorb their own space, right? So once things, in the moment when they're looking to cut costs, when there's uncertainty in the economy, they will look to put a bunch of space on the market for sublease. And then as things recover, they're like, oh, there was a reason that we had this space. We actually have people that we need to put to work. And so let's change our minds and pull that space back. So we're projecting a continued recovery in the office market and the leasing side through 2021 and on the capital market side, but it'll probably be 2022 before you'll work your way through all of that. You'll need, a vibrant economy. You'll need people back to work. Again, this is a Jerry Kranzel statement, not a CBRE statement, but it just feels like by Labor Day, people are going to be back. I think based on and of course, some of it is legal. The state of Pennsylvania obviously has to change, drop some of the restrictions that they have, as some of our neighboring states have done. But but for the summer, maybe it would have been in July or August, but it's just my personal opinion that that's a time when people traditionally take vacations. It's a time when people do a lot of stuff outside, which is much less impacted by COVID. It's a time when people typically take flex time anyway. So, I think in the fall, kids will be back in school, people will be back in work. Maybe we'll all have to wear face masks when we go into certain situations, but it'll feel much more like 2019.
Let me jump in on don't want this to be negative, but you're probably a little bit older than me. I'm 40 and I'm a newer broker. I've been a real estate agent for 5 years now. How much did 2007, 2008, and the difficulties then help prepare you and your clients to be able to deal with this? Everything's cyclical. I've only been through a couple cycles. You've been through more than I have, and your clients have been through a lot. Obviously, no one can prepare for COVID, but if you could share some of the insight or flexibility or pivoting that they did.
Well, I think the biggest thing is psychological for people who have been through at least that one cycle. I mean, for millennials who are new to the workplace, none of us have been through a global pandemic, right? I think the biggest thing is psychological for people who have been through this. I mean, I have to say in 2008, 2009, it did feel like maybe the world was ending, right? I mean, it was a really scary thing. Businesses were going to zero. I remember sitting with a CFO of a very large publicly traded REIT and said, we're all watching and waiting for Simon, the large mall owner, to put out a piece of debt, and we're hoping that's going to trade, and it's supposed to price at an 11% return. And if that actually happens, then we all know at least we can raise debt, even though it might be more expensive than that, right? I mean, I'm not sure whether bonds are trading, and obviously the mall sector's changed a lot, but you can currently borrow money at 3%, right? So it just tells you how difficult that time was. And I don't think anyone felt that way here. I mean, some of it was just faith in medicine and science, right? Like nobody thought, again, this is just my opinion, and you guys can disagree, but I think everyone thought, no matter how bad this is, we'll come up with a cure and we'll get through this. When you're talking about your financial institutions melting down, I don't have a biotech background, so I had no ability to figure out how they were going to do a cure, but you just had faith they were going to do that. When you talk about your financial institutions melting down, like that, to me, that was a much scarier thing, although people weren't. I mean, obviously this is different, and I don't want to minimize it because 500,000 people are dead. Mm-hmm. But I think people had a line of sight to the other side of this, whereas for the global financial crisis, in the moment, nobody knew what things were going to be like. Yeah, there was a big dislocation in real estate, coming out of the tech bubble, again, talking about different business cycles, in the late 1990s, there was a lot of people who were just investing everything in the in the stock market and not investing in real estate because, that when I used to talk to investors during that period of time, they'd say, well, why would I buy a piece of real estate where maybe I can get a 10 or a 12 or a 15% return when I can go in the stock market? I can make 50% this year. I can make 30% a day in the stock market. There was a big rise in day trading at that time, et cetera. But other cycles and this cycle too just seemed like something that would pass. And again, this cycle, you just have to say is different because so many people have passed away, and that's that lends a gravity outside of the real estate market that we all have to acknowledge. But from a real estate perspective, I just always thought we'll find a cure for this. People will get better, and we'll be able to get back to business. And business may change, and it has changed. I mean, retail is never going to be the same. Mm-hmm. Industrial, as we talked about, has gone through the roof. Mm-hmm. Hospitality will recover.
Hopefully.
Well, it will recover, but it's going to take a while. I was just talking to an asset manager from a large company that invests in hotels across the country. And what he was saying is that in one specific Midwest market where they own an asset, that for their weekend business, they're kind of back. They're where they were in terms of occupancy, in terms of the pricing, their average pricing that they're getting. But during the week, the occupancy is way down because business travel is way off.
Right.
Yeah. But this is going to be a thing for a long time. I mean, the way that people are interacting has just changed. I mean, when every restriction is lifted, we're going to be having Zoom calls with clients, not just phone calls. It doesn't replace being in the room with someone. It doesn't replace, a physical visit with someone, but it's actually, in my opinion, much more effective than just a phone call.
I always ask everybody this at the near the end, but Jerry, with all the things that you need to do during the day, all the different clients you talk to, different things you have to evaluate. How do you stay at the top of your game? Like what daily habits do you keep, just from a mental standpoint, that keeps you ready and keeps you nimble and excited to get to work and just get at it?
Well, you have to. I mean, the biggest thing that you have to do, in my opinion, is you just have to have a positive mental attitude every day, and lots of bad stuff is going to happen in the real estate business. Deals are going to fall apart. I remember I just started in real estate. The very first big transaction I was involved in, which was not big by my current frame of reference, but at that time it was enormous to me. And we put it was a 300 unit apartment building under contract. And we got to the end of due diligence, and the buyer dropped the deal. And I'm like, what do you mean they dropped the deal? This is, I already had that money spent. How's that work? So you have to just stay at your work and keep a positive mental attitude. And that's really the biggest thing. And I think it really helps if you love what you do. My wife is a school counselor, and she's great at it, and she really helps in a lot of kids. She works in the middle school environment, and she helps them pick high schools, and she really makes a difference in people's lives, and that's positive. But but when we talk about our jobs, and she's complaining about certain aspects, and I'm trying to counsel her through that. She's like, well, it's not fair because you like what you do. You enjoy going to work every day, And I mean, she likes aspects of her work, but I think I just think it's super important to love what you do and have a positive attitude.
Definitely.
It's tremendous. Thanks for sharing that.
Jerry, you're great. Appreciate everything you're doing. This is Real Estate Investor MBA. We love talking to our guests. Again, Jerry, thank you. Contact information is below, including phone number and email. Obviously, CBRE is a big company, so you can probably Google search a lot. But that's Jeremy Moyer over there. We just had Jerry on. I'm Tejas Gosai, Real Estate Investor MBA. Thank you, guys. We'll check you next time.
Thank you.
Thanks, everyone.